Welcome to AM Best Audio.
Dan Byrnes serves as president and principal at Asset Allocation Management Company, a Chicago-based investment firm specializing in managing portfolios for insurance companies. With over 4 decades of experience, AAM has built a reputation for delivering customized investment strategies that align with the unique needs of insurers across various segments, including property and casualty, life, health, and captive insurance. Under Dan's leadership, AAM emphasizes a client-first approach, combining deep insurance expertise with a nimble investment process to navigate the evolving financial landscapes. He joins us now. Dan, so glad you could speak with us today.
Hey, thanks for having me join.
Dan, you're new to the role of president. What do you see the future of AAM?
John, I'm fortunate to have worked at AAM for over 20 years, and the culture we've built here is one that, as you said at the beginning, combines top-tier client service with really good investment results for our clients. And we have a experienced team and a team that's been together for a long time delivering on that. So I think my first goal is to maintain that culture at AAM. We like to say here that we're collaborate with our clients. And as the investment landscape and regulatory landscape for insurance companies continues to evolve, we need to make sure we're nimble enough to take advantage of investment opportunities as they arise, and that our reporting and communication with our clients really reflects what's going on the regulatory side. So big picture, I don't see big changes for AAM in the future, but really a continued focus on delivering for our clients through cycles.
Now, AAM has a strong focus on fixed income investments. So Dan, how does this asset class serve the unique needs of insurance companies, and what trends are you observing in this space?
Well, traditionally, investment-grade fixed income has been the source of liquidity and stability in portfolios. In the last couple of years, we've had a few examples where it didn't fill that role. But over the last few years, we have actually seen some positive trends on the investment side for the fixed income market, primarily with increased yields. If you look over the last 5 years for the life insurance, for example, broadly, book yield in bond portfolios has increased 14%. For the life side, for the property and casualty and health side, where their bond portfolios tend to be shorter duration and they have more turnover, we've seen book yields increase even more. So for the P&C industry, we're seeing book yields across the industry up 33%, and for the health industry up over 50% over the last 5 years. That brings a significant source of stability to our client portfolios and their balance sheets and income statements. That was something that was sorely missing in the low rate environment we had seen before. Now, one of the benefits, silver linings of that low rate environment was the fact that it really pushed insurers and investors to think carefully about the risks they're willing to accept in a portfolio in an effort to increase return. Clearly, if you look at the rise in private asset classes on insurance balance sheets over the last several years, insurance companies have decided they can absorb more illiquidity in portfolios, and that's a trend we think will continue. Within ALM frameworks for clients, to the extent they can use private credit or investment-grade private placements or commercial real estate debt or other private vehicles that have less liquidity, those will add income to their portfolios. And at the same time, they'll have their investment-grade fixed income portfolio that, again, is throwing off more income than it has before and can provide stability and liquidity again for them in the future.
As you well know, Dan, AAM prides itself on a culture of transparency and client-first service. How does this ethos influence your relationships with insurance clients and the outcomes that you achieve together?
John, we at AAM like to think of an idea of having no surprises in client portfolios. That means working with our clients and making sure they understand why we've constructed the portfolio the way we have and what they can expect from that portfolio. So as markets change, as they inevitably will, as there are headlines in the markets, our clients know what to expect from their portfolio. So that transparency then leads to customized client solutions. So for example, a few years ago, interest rates rose significantly. Bond portfolios largely moved to unrealized loss positions. And for our clients that have CAT exposure, for example, and potentially significant liquidity needs, we worked with them to build liquidity sleeves in the portfolio. Think of almost like an enhanced money market strategy within the portfolio maintaining income, but if they did have a liquidity event, they had access to capital pretty quickly. And that also avoided the challenge of if there were significant claims impacting surplus, they weren't going to have to sell bonds at losses, also impacting surplus. So that solution worked out well for our clients over the last few years. Another example on the annuity side, our portfolio managers are constantly talking to our clients about crediting rates in their competitive environment they're facing. That leads our portfolio managers to go back and think about creative solutions to add income into portfolios, both on the investment grade side and in other sectors. And when we do that well, it really helps our clients compete and result in the best possible outcomes for them. By keeping an open dialogue and being curious about what's going on with our clients, we're able to really serve each client's individual needs.
As we've seen recently, volatility can emerge at any time. How does AAM prepare for volatility in portfolios?
You know, the fun part about volatility, as you said, it can appear anytime. You don't know how significant it's going to be, and you don't know what the ripple effects will necessarily be across markets and the economy. So as we think about portfolios, there's maybe two parts to this answer. One is from a broad asset allocation standpoint. As we're helping clients build those portfolios, we come at it from a long-term strategic allocation approach. We're not trying to decide what markets might do in the next 6 or 9 months, but build, again, broad allocations to serve for the long term. And of course, we have inputs for expected return and volatility, as everyone else does. But the most important part of that process is really getting from our clients the expected volatility from their underwriting side, what we should expect from that side of the balance sheet going forward. And we can put both their liability side and our asset side together to build portfolios that are accounting for ability to take mark-to-market volatility and surplus from investments, can account for capital efficiency in investment vehicles, and can focus on hitting return or income needs of clients. Specific to the fixed income side, as I said it before, we have a really experienced team, and they've been following their sectors and credits for a long time. They are consistently evaluating risk and reward within the investment grade space. And when we're not getting paid to take risk, we take risk out of portfolio. So if you go back to the fourth quarter of 2024, credit spreads were extraordinarily tight, and we weren't really getting paid for potential volatility that we knew would come at some point in the future. So we began to take risk out of client portfolios. We did have in the back of our mind, we had a changing administration in Washington and some ideas that may be coming from the Trump administration. And that might cause volatility. Now, the volatility we saw in April due to the tariff announcements was beyond even our stress case scenario. And I think that was true for a lot of investors if you look at reactions across the markets. But by having a consistent discipline around risk and return, we were able to take risk out of portfolios in the fourth quarter of last year and the beginning of 2025. And that really set us up pretty well for the period of volatility we've been in recently.
Against the backdrop of volatility, what should insurance investors be happy about today?
John, it's easy to get hung up in headlines around markets up and markets down in a given day and a variety of economic news. But I think as you take a step back, there are really two positives that investors should be thinking about today. First of all, it has to do with the investment grade fixed income side, and I touched on this before. Book yields in client portfolios or insurance portfolios have increased significantly over the last few years. And today we're still in an environment where you can invest new capital in the bond market at 4.5% to 5.5%, depending on risk tolerance and duration, et cetera, but still really compelling yields that we can add to portfolios. And that will serve clients well into the future. And like I said before, be a source of stability on the income statement and in surplus. The other thing to be thoughtful about is if you went back to the beginning of 2024 and looked through April of 2025, the S&P 500 is still up 19%. I think if you started in 2024 and said you're going to make 19% on your equity investments over the next 15 or 16 months, most investors would have been really happy with that. Certainly we're in a period of volatility, but equity allocations have really served investors well on the insurance side and have really been a benefit for portfolios. Volatility may come, but if you have a good asset allocation plan in place, you should be able to weather that storm.
Dan, so glad you could speak with us today.
Really appreciate the time. Thanks so much.
That was Dan Byrnes, president and principal at AAM. And I'm John Weber for Best Review Magazine.
Looking to get the full attention of the insurance industry? We have the platforms that will do just that. Whether it be AM Best TV, AM Best Audio, Best Review Magazine, or Best Day. Find out more by calling AM Best Advertising Sales at 908-439-2200, extension 5399, and have a great day.